Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Carrier Global. And for those who aren't familiar with Carrier Global, they were formerly a part of United Technologies. United Technologies, which then merged with Raytheon. So this was a spin-off that basically separated. And this is the HVAC refrigeration division. So not really related to as much of the Raytheon and, war and defense stuff that they would typically be associated with. So while this company is relatively new on the stock market, the section itself does actually have a much longer history for it. So we're going to be looking basically at what it looks like right now, do a stock analysis on it, and see if it's potentially a good value. But before we get into that, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get ideas on potential good stocks to buy, value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, leave it in the comments below, as I have gotten many subscriber requests in the past, and I will be doing them again in the future. And basically how we do this is I dive into the financials, analyze them, see what's good, see what's bad, and also see what's changing for the positive and the negative and how that may affect the valuation, so we can determine if the stock is well valued, if we want to even buy it at all, and potentially where a good value for the stock may be in the future. And with that, let's start looking basically at Carrier Global. So the first thing of like kind of these top level metrics, just look at the PE ratio. We can see right now they are sitting at quite a high PE ratio of 35.65, but a lower PE ratio in the future of 22.03. And this is based off the analyst estimates. And this does look like there is going to be potentially a significant jump in the EPS. But as I'm going to go into the financials, their EPS and basically their PE ratio is a little wonky for a variety of different reasons. So it's something you may not want to basically look in too deeply, as I will show. Other thing is they basically do have a little dividend yield of about 1.5%. I kind of believe in the future this company will become more of a dividend stock since it's basically not a big grower, but right now the dividend yield effectively, is a little bit on the lower side. And now let's dive in here, and you can see we don't basically have our 10-year history, but we still can see kind of from the analyst, the green line here is the revenue growth trend. And they are expecting a little bit of growth. This is not at a very basically fast rate. You can see the last 5 years, it's only averaged 4.4%, but their EPS has averaged 10.7. But as I'll show you, that's going to be a little bit weird for a variety of reasons. One thing we basically can look at is the return on invested capital versus the weighted average cost of capital. And you can see basically it has dipped down under their weighted average cost of capital. But again, this is based on the earnings they're showing. And there are a few things I'll go over, which I've repeated now several times, that kind of are maybe, deflating the earnings a little bit and inflating the PE. So we kind of are going to have to say, oh, well, this is really low. It's not necessarily bad. Maybe it should be a little bit higher. But even when it was a little bit higher back here, we're only sitting maybe 9-10%, which isn't that great. And, the weighted average cost of capital, well, it was above it. But, for a slow growing company, this, necessarily isn't a big plus, I would say, in my opinion. As you can see, basically the revenue, there has been a little bit of bumpy growth, goes up a little bit, contracts a little bit. It's come down from a little bit from 2024 here. And the first thing to look at, I always, go over is basically the gross margin. Well, right now it does look like it's a red flag that it's contracting. I'm going to say that this is actually probably not a worry, because as we're going to go later down basically on to the cash flow statement, we're going to see this is basically being caused because of their depreciation from an acquisition. So this is one of the reasons it is kind of artificially lowering their earnings a little bit. So this is one of these things that you kind of do need to see of like, oh, why actually did the gross margin go down? And other stuff we look at, kind of can determine if this was, actually a real problem to look at or not. Next thing basically is the operating margin. And the operating margin has had a pretty similar contraction as to the gross margin for that same reason, which actually is relatively, good in a way, because it does show us, even though that the revenue is, kind of flat and, kind of barely creeping up at some points, they are still able to keep their total operating expenses kind of in line with the growth of the revenue. So overall, that's an okay, point there. But I would say right now, as I'll show a little bit later, probably the gross margin at best we're looking at, it's actually just like stable. And where I do see more of a problem basically on their income statement here is they do have a very high interest expense. at almost $460 million. And right now, while they do have a little bit of interest income here, you can see it was higher before, but they spent some money, so it's lower. You do have to consider that basically if the Fed's funds rates go down, they're not going to be able to make as much interest anymore. And that's going to mean, well, their net interest expense is basically only like $364 million right now. If interest rates go down, their interest expense, actually could get higher. And this is like, actually a fairly big interest expense in comparison to their operating income of only 1.9 billion. I typically like to look for about a 1 to 10 ratio to say, that's a very manageable amount of basically like income expense, giving you them flexibility to do acquisitions or take on more debt. And right now, they're not really in that flexibility state, and they probably kind of want to work on actually paying down a little bit of debt. But again, we do probably actually have to fluff up this number a little bit, but even if we, for the previous reasons, but even if we do that, you could say that if this was like, 2.5 billion, it's with $460 million of interest expense, that still really isn't a very comfortable ratio. And kind of for the margins, we're going to kind of leave it looking at the gross margin and the operating margin, because once we start getting a little bit lower, you can see there's been a lot of other basically income pops. And this is basically because they've been selling off some other sectors of some businesses, along with doing some acquisitions, which has made them realize some other incomes which are showing up here. And then you also have to realize with acquisitions they've done, what might happen in the future is that if they have to do any write-offs for them, then we're going to start seeing some losses. So, that kind of starts skewing what we're seeing a little bit, lower on the income statement as well. And then another thing that's kind of, that for the same reason, which is actually causing the tax rate to pop around, the tax rate is wildly fluctuating as well. And this has created kind of a very more inconsistent net income that's not as reliable, in my opinion. So I guess this is one key thing to look at, is when you are looking at a company, you have to see, is the PE ratio you're looking at actually something you can reliably use, depending on what's going on and how the different things are flowing around their basically financial statements. And in Carrier Global's case, I do not think PE is going to be a very reliable way to, analyze and look at the company at face value, although you kind of can use it in a more normalized perspective in the future. And we can see they have been basically buying back little shares, but they do some issuance as well. So, while the company is actually actively working on buying back shares, there has been probably acquisitions, I believe, that have increased the share count at the same time. And when we do get onto the balance sheet, you can see right now basically their total current assets are sitting about 8.5 billion, but this was much, much higher before. And things like this do come in to an important thing, is when you don't have as much cash on your balance sheet anymore. If you were doing a lot of buybacks in the past, like share buybacks, well, you can't do as many share buybacks anymore. And right now they're sitting at basically $8.5 billion on their balance sheet. You can see before they had 10, 19, 10, 11 in a lot of these previous years. And you compare that to their current liabilities. Well, the current liabilities has been pretty consistently around $7 billion. Okay, 7.8, down to 6 there. But you can see right now how the current ratio, while still positive, is a lot tighter compared to these previous years, like 2022, 2023, and 2021, when they had huge surpluses of cash, which we don't have and can't see basically on the balance sheet anymore. So that does affect their potential to do certain activities like share buybacks and acquisitions in the future. You also see before they didn't have basically a lot of, nearly as much debt in 2022. And, they took a lot in 2023. And they have managed to get it a little bit down, but you also do have to factor in, it's got a little bit down. They actually increased their short-term debt. So it's not got down quite as much as you would have thought. And honestly, over these last couple of years, they really actually haven't paid back that much, in my opinion. And when we do look basically at their total equity, it's sitting at about $14 billion. But again, one big problem with this is they have a lot of goodwill from the acquisitions they've done, which is $15 billion. So overall, basically, their balance sheet is sitting, when we're looking at equity, taking out the goodwill, a little negative. It's definitely not as strong as it was before. Is it terrible? No, I wouldn't say it's terrible, but I wouldn't say it's like really like good or that attractive, because they do have a lot of debt, and we did know that from basically the interest expense. But where I think things get interesting and kind of really understand what Carrier Global is doing and what you're going to have to look at basically going forward to analyze this company is on the cash flow statement. Because the first thing we can basically see is this, cash flow from depreciation. And well, from 2017 to 2023, it was relatively steady. you can see basically after that, 2024 and 2025, there was a massive tick up from, in the basically the 300 million to 491 million to 1.2 billion and almost 1.3 billion. And when we compare that to our purchase of plant, property, and equipment, you can see basically in 2023 and all the years prior, they were pretty much just repurchasing new purchase of plant, property, and equipment at replacement value. But now in 2024 and 2025, well, it has ticked up a little bit. And actually in the last year, it's probably in line with, previous, years. So it's really just kind of the old replacement value. This is substantially lower than what the cash flow from depreciation is. And when you have such a higher cash flow from depreciation, that is going to basically make your earnings look smaller. And this is the reason why I said earlier on that, well, it looks like the gross margins basically have compressed. I don't think that's really the case since, in reality, this extra depreciation here is just probably due to this purchase of the business, which I believe this was a company in Germany. They wanted a bigger footprint in Europe that, specialize in heat pumps and other, HVAC technology. And kind of getting into that, you can see that there has been these purchases of businesses going on with these very little ones going forward. So this is probably an activity you would see likely going forward, at least the little purchases, because of their high interest expense and high debt. It's very unlikely and probably not possible for them to actually do any large acquisitions. And additionally, on top of that, they have been doing some sales of businesses, selling off one big sector here, which gave them some cash, and some other little ones. So you kind of see this company is, with all the money moving in the different sectors, and after it's separated, it's still trying to find exactly what its business is, which does make it actually a lot harder to project, what may be going basically forward in the future. But you can see basically in the last year, other than this $8 million here, there really hasn't been any other sales of businesses. So this is probably not going to continue in the future. But anyways, the main thing is that this basically is skewing the gross margin quite a bit. So really, what are they doing at the end of the day? Well, we can see at the end of the day, they do actually operate more, having around this, $2 billion, a little bit over a free cash flow, at least in 2023 and 2025. This is being, a little bit skewed by some other things. And, that's really what they can basically have that money. And what can they do with it? Well, they can, do share buybacks, they can pay dividends, or they can pay off debt. So, we're going to look at that and actually see what they're likely going to be doing with that in the future. And you can see, well, I do think, like I said, this company will become more of a dividend stock. They actually have been upping the dividend at a good rate. So this is where at least, close to $800 million of this little bit over $2 billion is going right now. But then you will notice here that we have net issuance of debt. In the last year, they did pay down a net of $900 million, but they also did a bunch of share repurchases of almost $3 billion. And if you add up all these numbers, the 772, the net issuance of debt here of 889, and the $2.892 billion of repurchase of stock, you'll find out that's a lot more than the free cash flow. And well, I think they're likely to probably up their dividend a little bit in the future, because that's just one way when these more boring stocks that most retail investors don't look at and institutions like to look at, they kind of attract them in a little bit with the the dividend and the alleged stability. You kind of have to consider 800 million or even up to $1 billion they're going to be kind of holding back for dividends, leaving them maybe only a little bit over $1 billion left of their free cash flow. And they're going to have to decide, is that going to go towards paying down debt, or is that going to go to the repurchase of stock, or a little bit of both? And if you were to split that, well, it mean they're paying off debt very slowly and they're not repurchasing shares very quickly either. And I will just bring up here the stock-based compensation is pretty minor, only 74 million a year. So this is basically going to, rapidly slow their ability to buy back shares. And I guess basically that's the whole point, that in the past, they were able to a few of these more aggressive ones. Now they don't have that excess cash on their balance sheet. When you do see stocks that have had, quick reshare purchase, in the last few years, quicker reshare purchases, you do have to see, it's like, can they actually do that going forward? They do that from their free cash flow, or is it because they had a temporary surplus on their balance sheet? Because this is something like other stocks still take out debt and actually do reshare repurchases, which I went over, like HPQ did that. And when I originally did a video on them a couple of years ago, I did show that it's like, well, because they took out the debt, now they don't have a strong balance sheet. Well, they're going to have to scale back those share repurchases. And with that, let's get into the interactive chart. I'm going to bring up the analyst estimates here. I do like the analyst estimates from revenue a little bit more than the EPS, and you do kind of have to factor both in because this is what the markets generally is pricing in. And you'll kind of see, as we already kind of looked over the EPS, over the next few years, they're expected to grow at a pretty slow pace. And then in the future years, they're expected to be kind of a more rapid growth. But I think the further you get out in time, the less and less predictable basically it actually is. So kind of in the short term, there is very low growth expected, going forward. And if we look at the EPS with estimate without NRI, you can see that this is actually at a lot more rapid pace. EPS right now this year they're expecting $2.77, which compared to last year 250, it's 256, which isn't huge. But then the next year it's 317, so that's a pretty significant jump over 10%. Then 317 to 362 to 452, and it's kind of showing this very aggressive EPS growth trend. Which this is where a little bit more of the previous financials we looked at, I like to go and look and actually see do these actually analyst estimates, at least the EPS ones, because I believe revenue ones are typically a lot more forecastable, accurate, and I do not believe these are going to be the most accurate EPS estimates. And well, basically, why is that? Why is that? Well, this would basically have to assume that they're going to be either buying back a lot of shares, or expanding their margins, either the operating or gross margin. And we already know that if we had kind of factored out the depreciation, the operating margin and gross margins would just be stable. Which is fine. It's stable there, but there wasn't any trend of them actually growing. And even if they were to factor normalize their depreciation schedule and weren't depreciating much in the future, that would just kind of be a one-time bump up to that normalization and wouldn't have this consistent headwind. And it's the same thing with basically the share buybacks. Right now, they really don't have enough free cash flow to be doing a lot of share buybacks if they want to pay back a little bit of debt at the same time. So I don't really see where this level of, basically EPS growth is going to come from. And if you kind of do a little napkin math, as I always like to say, say even take the 317 number here, realistically, what is a fair PE you would actually want to pay for this company in more of a normalized environment, even if we factor in a little bit of weird depreciation? Say it's a bit higher. Would you really be thinking this company right now, which is trading, I'll just bring up you can see the chart there, trading at over $60, it would be worth kind of, forward PE wise, around, a 20 PE, because this is, a couple years in the future. Looking at everything I've seen basically from the financials of, having a lot of debt, very basically slow growth, I'm not seeing any big pluses that would, really that I really wouldn't want to pay more than a 10 or a 15. And, a 15 may be fair, but, you do want to buy stuff when it's actually undervalued. So also with that here, I can get that to go away there. We're going to bring up the PE ratio. And this is one of these things with the PE. You can see sometimes it was looking really low, sometimes it was really looking high. But as we went on before with the financials, that's because they have these big one-time incomes. So kind of looking at these past PEs, it could have given you an illusion because they have a sale of the business, and it makes it look like they're trading at a 10 PE when that's probably not really the case, and then they don't, and then there's suddenly a 40. It's not always basically a reliable metric to look at. One thing you kind of can look at is the price to sales ratio. A little bit more reliable is going a little bit more with the flow of the stock here, and you can see right now they're sitting at about 2.42. It's been very expensive, as high of 3.46 during 2022. It was as low as a 1.47, so that'll kind of be a bare minimum to target at. And kind of when they went public, at least with this spinoff here, it was even lower at 0.68. So with that, I'm going to jump into the stock chart here, and you can kind of see the trend I have going. It's really just trying to see where the trend of the stock is going to go, what's actually realistic in the future. And I've kind of just gone with these top points, as a lot of the times these top points end up actually kind of more determining the realistic growth trend. And if we kind of see the rate this is going at, this actually would be a kind of fairly optimistic trend of 10% growth. So this might even be a little bit more bullish than the company maybe actually be. But if the company does perform well, I do think a 10% growth trend in the future, that's EPS, after the basically the share buybacks there in the long term, could be achieved. But, we look at this where the stock is right now. I definitely, don't think it's a very attractive value right now. And I kind of look at these channels, just getting a little bit more into technical analysis here. You kind of say, oh yeah, you got this, trend here, but based on the valuation, I'm kind of going back to this point here, which could be the bottom, doubling it up. And personally for me, if I want this stock, I'd be looking more down here and attractive value, because as we did look kind of for the valuation, that would potentially bring up these 2022 lows, which would actually mean we have a lower price to sales ratio there. And around $30, a couple years in the future, based on the EPS of like 317 or mid $3, that does put at the more of that 10 PE ratio, which I would believe for a company in this financial kind of their financial state would be a more attractive value to buy. So anyways, right now, Carrier Global, it's definitely not a buy for me. I'm basically gonna wait. It's on my watch list. As I say, I have a lot of stocks on my watch list, and the thing is, you never know if it's actually gonna reach this level. Things could just chop sideways for 5 years for all you know. But I try to get stocks when they're on a little bit more of a potential deep discount. So anyways, basically that's what I'm looking at. Another technical point I'll just kind of show is if you just look at the moving averages, well, what's happening? The stock is now kind of trading underneath them. It hits the moving averages. It's going under. What's happened again here? Well, it's hit these moving averages again, and it looks like this actually could be turning into a little bit of a downtrend. And sometimes these downtrends can turn eventually into a little bit of a falling knife. And even if it isn't, if we were to kind of chart out the downtrend, if it just traded uniformly down, kind of like I'm saying, by that 2028, this thing actually could trend down into the mid $30 range. And at that point, that would kind of be what it would take for me to be looking at purchasing Carrier Global in the future. So anyways, I hope you like that stock analysis. It, gave you a few insights into their financials, other things you want to be reanalyzing and looking at how they develop in the future. As well, I'm saying this, you could see there's a lot of dynamic stuff basically happening on the financial statements right now, and there's a lot of things with the acquisitions and sales of businesses that basically can change. And if they were, for example, to get a acceleration suddenly in margins, which the analysts kind of estimates were predicting, although I was thinking it kind of likely, since I don't see the actual growth drivers for that, basically that would keep them probably in this upper channel basically going forward. And at that point it's like, well, it's fine, I can miss out on the stock. You don't have to buy every one. So anyways, make sure to subscribe to the channel, like the video. If there is a stock you want me to look at, leave it in the comments below, and I'll see you in the next stock analysis.